Good afternoon, everyone. Good morning to those of you joining us from the West Coast. Welcome to our program today entitled Moving Money Overseas and Back, What Every Nonprofit Operating Internationally Needs to Know. My name is Jeff Tenenbaum, Chair of the Nonprofit Organizations Practice at the Venable Law Firm. And as many of you know, this program is part of the monthly series of Venable programs on nonprofit legal issues that we do here in our D.C. office for those of you who can come by and join us for lunch, as you did here today. And welcome to the approximately 250 of you who are joining us by webinar and video webinar across the country today. Let's see. First, to get started, for those of you in the Trade and Professional Association community, and there are some of you participating today from that world, these programs are eligible for CAE continuing education credit. Next month, our program is entitled An Independent Contractor, an Employee, and Their Attorney Walk into a Bar. Why this is no joke for a nonprofit. Credit to our colleague Doug Mishkin, one of the panelists on next month's program for that title, and it is going to be a terrific program that I hope you guys can join us for. We are going to be taking the months of July and August off, but we will be back and restarting our monthly programs in September. Today's program is being recorded, like all of our programs are, including now with video recording. The program will be available tomorrow on our nonprofit YouTube channel. All of you will receive an email tomorrow with a link to the recording of today's presentation, along with the PowerPoint slides and handout materials and full speaker bios. Those of you in the room have a handout booklet that has a copy of the PowerPoint slides, along with our speaker bios and some related articles and handout materials. And then those of you on the webinar received in your confirmation email today a link to the PowerPoint slides. And like I said, you'll all get that email tomorrow, which you should feel free to forward on to colleagues and others who you think may benefit from this. In terms of questions today, those of you in the room, feel free to ask questions at any time. Like most of our programs, we like to make them as interactive as possible. Just raise your hand, wait till I call on you, and wait until the microphone comes to you so that everyone on the webinar can hear your questions. Those of you in the webinar, please pose your questions to me using the chat feature on the webinar software, and I will pose those to our speakers at the appropriate times. But definitely feel free to ask questions throughout, and be patient, those of you in the webinar, if I can't always pose questions exactly when they are asked. Now, I'm going to give brief introductions of our speakers. Unfortunately, the bios are too impressive and too long to cover extensively right now, but you have copies of those in front of you. But we're very fortunate to have three of my close colleagues joining us for the program today. I work very extensively with all three of them in these areas and many other areas, and you are most definitely going to benefit from their wisdom and experience here today. To my immediate left is Lindsay Meyer. Lindsay is a partner and chair of our international trade practice. For over 30 years, Lindsay has been with Venable and worked in this area. I've worked with Lindsay extensively in all aspects of international trade and regulatory issues relating to our nonprofit clients. She's a true expert in this area and concentrates on all aspects of international trade and customs. She regularly advises our clients on compliance with their import and export control laws and regulations, the Foreign Corrupt Practices Act, and appears before numerous regulatory authorities such as the U.S. Customs and Border Protection, International Trade Commission, the Treasury Department's Office of Foreign Asset Controls, and the Committee on Foreign Investment in the United States, CFIUS. To Lindsay's left is Friedemann Thoma. Thank you, Friedemann, for flying in from our San Francisco office for today's program. Friedemann is the newest of our colleagues on the panel today, but by no means any less significant. Many of us throughout the firm have discovered Friedemann and his group and his talents in kind of the international tax and employment area. He has quickly become very popular amongst many of our nonprofit clients that operate overseas. I've become a big fan of his, and he's a terrific addition to our firm and particularly to our nonprofit practice. Friedemann is a partner in Venable's Tax and Wealth Planning Group who focuses his practice on corporate international tax planning and U.S. taxation of foreign operations. He has managed large-scale global structuring projects, including the design, implementation, and post-implementation phases for organizations in various industries and jurisdictions. Friedemann began his legal career at an international law firm advising domestic and foreign investment funds and investors on matters relating to inbound and outbound tax, partnership tax, real estate tax, and executive compensation. And last but not least, to Friedemann's left is Yossi Ziffer. Yossi is a partner in our nonprofit group. Well, he straddles our nonprofit group and our tax and wealth planning group. He focuses his practice on the full array of tax, corporate, and strategic needs of tax-exempt organizations, including public charities, private foundations, hospitals, private schools, and trade and professional associations. Yossi also does extensive work with our U.S.-based nonprofits that make grants overseas, and that's the topic that he's going to be focusing on here today. He's a key member of our nonprofit group, and we're really pleased to have him here today. So without any further ado, I'm going to turn it over to Lindsay to get us started. Lindsay?
Great. Thank you very much. Let me move this mic. I really enjoyed the introduction, except for the 30. That made me sound really old. So I started when I was 12. Let's just go with that. So I'm going to be discussing the non-tax issues today. And most folks, when you're thinking about following the money, people immediately think tax. Well, there are a lot of little traps that are out there from an international perspective that are beyond the realm of tax. So I'm going to cover those areas. As Jeff said, please feel free to jump in. We are here in Washington. I have a difficulty of talking into the alphabet soup speak. So if I speak in acronyms and you don't understand, give me a signal and I'll define what I'm saying. So just briefly, in terms of the topics that I'm going to cover today, we're going to start really at a very high level, just thinking about what is the form of the entity, because your form of your entity can dictate some of the liability and traps. So we'll start there. We'll touch upon foreign jurisdictions, give some consideration to the places where you're doing your activities to see, where there might be challenges and restrictions. The old follow the money theme is very well known these days from a corruption standpoint. It used to historically be limited to the U.S., but now the world has gotten onto that gravy train of finding corruption and battling it with anti-corruption efforts. So we'll talk about that. We'll also discuss some other U.S. law considerations that impact your overseas transactions when there is cross-border money movement. And then we'll talk a little bit about some steps to enhance your compliance, some ideas. And then finally, you can't make this stuff up. We'll talk about a couple of real-life examples for you. Okay, so let's jump in. So as you sit here today thinking about what your activities are, you want to consider what your goals are, whether you're just putting your toe in the water or whether you're actually diving in for a full swim. When you're talking about the cross-border money issues, those also follow your level of involvement. So many times this is an evolving process that most nonprofits will start with putting their toe in the water, working with a group overseas that's affiliated like them in the same line of goals and missions, up to establishing an actual presence in a particular country. Now, just because you only have put your toe in the water doesn't necessarily mean that you don't have liabilities and potential restrictions with your business activities. In other words, you can't outsource the problems. So give some thought to that. And generally, for operations overseas, for nonprofits, you often see it in the educational realm. You may see event coordination. You may see the distribution of materials, whether that's gratis or for a licensing fee or the like. So there can be any level of involvement and actual participation in a particular country. So when you're thinking about this, generally the more established you are, the greater the risk. So if you've got actual presence in there, you've got employees, you've got ongoing activities, you have a physical presence, generally your level of restrictions are greater. But please don't take it as if you're just working with an independent contractor in a particular country doesn't necessarily mean that, you're free and clear. So it's a whole range. And we often see the start being hosting a one-time conference all the way down to then starting a joint venture and then next establishing an in-country branch up to actually establishing a nonprofit entity under the local law. So it's an evolution is what we tend to see. And at each stage, each different level of involvement can present different levels of risk. So more importantly, how are you supporting those activities? What are the needs to either transfer money, establish a bank account there? Are there various restrictions that will be imposed? So let's dig in a little bit more. Okay.
And before we move on to that, as Lindsay well knows, these basic steps that we're talking about and basic options and kind of deeper and deeper levels of involvement, they also vary very much from country to country. And the rules are different from country to country. Sometimes you don't have the option to establish just an in-country branch depending on, the nature of your activities and what country it is. Sometimes you might want to establish a separate local nonprofit entity under local law, but it's really not possible, and you have to do it as a for-profit entity instead. And so it's important to understand that while we're giving a high-level generalization, the rules really do vary country by country, and it's important to be aware of the various options per country and the pros and cons of different approaches.
Yeah, that is a good point, because it's certainly not a one-size-fits-all, and you may have started a nonprofit organization in one particular country and say, well, this is great, this has worked very well for us, we've got good communications, it's fulfilling our mission. Let's just take that and replicate it in the next country. And frankly, it doesn't work that way. So good point.
And one thing to add about this is what we often see kind of like when organizations go abroad, that there is a tension between what's the right thing to do and what's kind of like the costs involved in that. And so if you put your toe into jurisdictions, you have some folks going overseas and doing some activities, organizing some events. From a legal perspective, many times the answer would be, well, set up a local entity in country in order to mitigate some of the legal risks. But that's, of course, in kind of like in tension with the cost associated with those setting up those structures. So what we often see is that companies kind of like start kind of tipping their toes in, and there's kind of like a scale that at some point when you really start having too much activities, at that point the kind of like the cost justifies having a more kind of like a structure or a legal structure that is more solid from tax, employment, etc.
And one last point to mention, and kind of the last bullet point in this slide gets to it, but this whole program is about money and moving money. And of course, and you guys know this even better than I do, but in certain countries, depending on the nature of the corporate and tax form of the entity, there may be restrictions and prohibitions even on moving money, for instance, back to the States, or moving money into it, or the ability of donors in that country to take the equivalent of a charitable tax deduction. So all these considerations have to be taken into account. Like, for instance, in the UK, if you set up a registered charity, then UK donors can take a charitable tax deduction. But then the flip side is that the UK laws don't allow, for instance, the parent entity in the US to exercise as much control over that entity as you might otherwise like. So there are trade-offs in these various jurisdictions depending on lots of different factors. And these are the kinds of things that you need to really think through, talk through with your counsel and advisors and make informed decisions.
Perfect segue to the next slide, which is, in the world of doing business, not all countries are equal. And so this is from an organization, Transparency International, which many of you may know. It's a heat map. So the darker the red, the greater the level, as denoted by transparency, the greater the level of corruption. You will note, however, that the U.S. is not kind of that light yellow. Some say that's due to activity in New Jersey and Chicago. I don't know that for certain. Just hear it. So you do want to give some consideration, because not all countries are alike, and from both the restrictive standpoint as well as the risk standpoint. So it is smart to think about where are you doing business and how deep is the red in that particular country. Okay, so the Foreign Corrupt Practices Act is really the big heavy for us when you're doing business overseas, and when you're transmitting money overseas. This was a law that was enacted in 1977 that really was out there on its own, and the U.S. was out enforcing it. Frankly, not as strictly as it certainly has over the last several years, and the purpose of it really was tracing the money looking at mostly U.S. organizations, but that certainly has evolved. And over the last several years, activity by nonprofit organizations and the like are clearly within the target zone as well. So the anti-bribery provisions, which are the ones that are applicable here, prohibit the paying of money, offering, promising to pay. You don't actually have to undertake the whole payment itself, but just merely making the offer to pay anything of value with a corrupt intent. And let me just note on that, the corrupt intent you can pretty much trip over as a bar. And it's directly or indirectly. So if you are paying that to a foreign government official, even with a political party, when you go overseas, foreign government official is a much more broad basket. So if you think about it, most hospitals, for example, overseas are owned by the government. So even the doctors working in the hospital, and you want to provide them with something so that they get to know you better. And, it's the way things are done over there. We hear that often. The provision of money or offer to give money or something of value can run afoul of the anti-corruption law in the United States. And more recently, there has been a worldwide effort, not only for the U.S. law, but cooperation with other country laws as well. So if you look around the globe today, most industrialized countries have anti-corruption laws that work in a similar but not identical fashion with the U.S. So that's certainly a risk, because this is a classic example of follow the money. The U.S. government, the Department of Justice, certainly follows the money. We saw our heat map, so there are certain red flag countries which are known to be more active in corruption, whether it's trying to get permits for employees to work in your organization, or whether it's trying to work with the customs service to get something in. Maybe you need equipment or the like. So you have to be mindful of that. Again, foreign government official is very broadly defined here. So you want to be sure that your activities in a particular country don't run afoul of that. You also can't outsource your liability as well. So if you recall, it was directly or indirectly. So even though you may be having an agent, you say, well, I'm just paying the agent to undertake certain activity to get us established as a nonprofit entity in a particular country. Whatever they do with the money, I want to turn a blind eye. I don't know. Well, it's direct or indirect. So you as an organization can run afoul of it through the actions of your agents overseas. And frankly, from our perspective, that's the biggest risk. It's not necessarily the activities of employees or personnel within an organization directly, but it's those who are operating on their behalf. And certainly other countries, as I mentioned, with the OECD, there was an international agreement to also enforce anti-corruption. And so many countries that you wouldn't think of, China, for example, Brazil, have their own anti-corruption laws, and they too see the activity of the U.S. government. These cases they get settled, frankly, because people don't want to have an adverse judgment against them, so they settle. But the dollar figures, the millions and multi-millions of dollars that get assessed, that go back into the coffers, that then help support more enforcement and more personnel who pursue these cases. One other interesting note that there's the ability to have a local law, anti-corruption law applied to you, as well as the U.S. government law. The U.S. government, our laws tend to be more flexible in terms of gathering data and information. So even if you have a cooperative investigation among different countries, usually they'll say, U.S., you go first because you can subpoena information. And then when you're done, thank you very much. In a very cooperative effort, we would love for you to hand that over to us, and then we'll take over with our side of the investigation. So this is a classic example of, follow the money and be careful.
And for those of you who might think that nonprofits, it doesn't really come into play here. Why would the Department of Justice care about nonprofits? I mean, granted, we do, Lindsay and I and others have done a lot of training, for our nonprofit clients and their frontline program staff and others on the FCPA and how to comply. But we also deal with enforcement. And just yesterday, one of our nonprofit clients received a grand jury subpoena in connection with some overseas activities. And just like Lindsay said, there are other overseas authorities investigating as well. And a nonprofit in the middle of this has now been drawn in, unfortunately. And it does happen on a somewhat regular basis.
Yeah, and so what you want to do is really, you want to build your first line of defense. You want to put yourself in a position where you've got the procedures, and it's not just some book on the shelf, as in other things. You want to have procedures, and you want to educate and train your folks so that they have an understanding, and not only your personnel, but extend it to your agents and have them, go through a training program and sign a certificate that they understand the issues. That gives you your first line of defense. It might not be a silver bullet at the end of the day, but it certainly helps in such matters.
Yeah, it helps prevent violations from occurring, but it also helps you negotiate a better and quicker and less expensive resolution in the event that someone trips up.
Yes, question.
Hold on, if you can just wait for the microphone there.
If you don't mind going back one slide, I was interested in the certain limited exceptions and affirmative defenses. Can you go over what some of those might be?
Sure. So there's an affirmative defense of, if it's written in the laws of a particular country that you can bribe the official, then you're good. That sounds good, right? Okay. There are no such laws. The limited exception is for grease payments, and that's actually the term that is used, grease payments. So if a payment is made for a non-discretionary action, then a particular activity is within the approved or authorized zone under the FCPA. But that becomes a slippery slope because, number one, only the U.S. permits grease payments, and they have to be at such a small denomination that they don't have an impact. The reality is, what you find oftentimes, a grease payment may be made to, let's say, we can't make this up. So we had a matter where we'll just say we had a friend who was operating overseas, and they needed to get work permits for personnel to come in, and they needed them in a significant number. So it wasn't just one $20 payment, which overseas in the particular country was a bit of money, but $20 here is, 2 cups of Starbucks, I think. But the problem was they needed them regularly, consistently, and the number kept growing and growing and growing. And the Department of Justice said that doesn't fall within the grease exception, grease payments. Even though it's $20, you're getting a pattern. And if you assess and amass it all, it really does have an impact. So if you look globally, really, grease payments, you have to be very, very careful with that, because even though you may get a free pass in the U.S., if it does truly fall within the grease payment allowance, that is not a free pass overseas. So if you're also subject to other jurisdiction requirements, that you wouldn't get that free pass. Great question, though. See, somebody's reading at least the fine point of the slides. Excellent. So some other U.S. law considerations. Obviously, accurate recording and reporting is critical. The interesting thing. This is not so much in the nonprofit world, but because we just talked about the anti-bribery provisions, but there are also complementary books and accounting provisions that are enforced by the SEC. And ironically, under that provision, if you had written down bribe to Afghani Minister of Health in your books and records, you would have an accurate reflection of what you did. Now, of course, no one is going to do that. So, but nonetheless, you want to make sure that you don't have 2 sets of books. The other area we see some areas of potential risk are the slush funds. They say, well, we just have, kind of this small account for folks in country so they can just get their job done. It's very challenging to have money, currency exchange, and there are all these restrictions. So we're just going to set aside a chunk of change over in a slush fund for them. Beware of the slush fund. Beware of the slush fund. Another is the anti-money laundering concerns and considerations there. And really the key is know your customer, know the folks with whom you're working, whether it's with the various agencies that you're involved with for your mission, whether it's you're dealing with different operators, conference coordinators, really anyone that you're dealing with overseas. Make sure you know who they are, that they're not wearing multiple hats. That's often a problem. Someone overseas can be, the Minister of Health and the president of an organization, and at the same time. So you have to be mindful of that. In what capacity are you dealing with those folks? There's also anti-boycott reporting requirements, and people say, well, that's bizarre. We're not in the business of moving commercial goods. But you can find those in provisions such as banks. There are a lot of banks that are on restricted lists by the U.S. government, so don't use X bank specifically. And the request not to use a particular bank is a reportable action, even if indeed you don't use Bank X. So as a U.S. organization, there's an obligation to report that to the Department of Commerce. Then finally, as we all know who have crossed borders, when you come back through U.S. Customs, you need to fill out the form or stand at the little kiosk these days and tell whether or not you're bringing in more than $10,000. And educate your folks as well. This is another example where we saw it in action. There were payment difficulties for a team of folks at a nonprofit that were coming back to the United States, and they were like, well, we're both flying in the same plane. We'll get the payment in cash, and then we'll properly distribute it once we get back here. Let's see, it's $16K, so you take 8, I'll take 8, we're good to go. Not so good. Not so good, because again, there was the whole thought pattern of, well, it'll just be easier. I'll fly in through, Dulles. I just want to get home and see my kids. But actually, you have to be very mindful of that. And the U.S. government does track, and the Customs Service, there is the ability to report that, record it, make it, consider it as a false statement if, in fact, the organization is coming back and the folks are bringing more than $10,000. So be careful of some of those. And these are the ones, it's not tax, and they're not necessarily ones that come to mind immediately, but they're certainly all risks. For even more fun, let's talk about the OFAC sanctions. I've slipped into DC speak. So that represents the Office of Foreign Assets Control. I know it's very unsettling. I hear you. They are a very stealth organization here in town. It's part of the Department of Treasury, and OFAC is responsible for tracking transactions, commercial, non-commercial, so certainly nonprofit activities of persons that restrict our dealings with people, entities, organizations overseas. So you can have, like as I said before, you could have a restricted bank. You certainly have that here. People, historically, people knew that there was the thou shalt not, right? Thou shalt not deal with Cuba. Thou shalt not deal with Iran. Well, the sanctions these days have gotten much more targeted and much more specific. I think historically, you could compare the OFAC sanctions laws as a sledgehammer. It would just be a thou shalt not. It was very easy. You knew you couldn't deal with these folks. Now it's much more precise, and the sanctions are really crafted with a surgeon's knife. And, there are particular individuals in a particular place that you also, now can't deal with. So it's much more complicated to kind of follow the rules and understand who you can and can't do business with in a transactional sense. And then finally, there are the export control sanctions that are often kind of the kin to the OFAC sanctions. Usually one goes with the other. There can be some restrictions. For most nonprofit organizations, that doesn't tend to be an issue unless, for example, let's say you're in a health mission and you want to provide certain medical equipment by way of an example or a sample for your organization overseas, or for, let's say, the Minister of Health, so that they can understand the mission and what you're trying to achieve, and you need to send over those items, then you would need to be mindful of some of the export control restrictions.
Lindsay, we have a question from the webinar. It says, are you seeing nonprofits having trouble getting international wire transfers completed due to concerns related to anti-terror financing? And if so, how are they coping, using money transmitters, carrying cash? And don't laugh, we actually have had that issue very recently with a client of ours that's operating in doing a lot of relief work in Syria. And you don't just wire money to a bank in Syria because they pretty much don't exist anymore. And so you do have to carry cash. And Well, I'll let you speak to this.
Yes, there are a lot of difficulties, and the piece about the sanctions, and if you think the heat map as well, there are certain geographic zones where it's frankly challenging, and these issues can change day to day. So you can have, just a couple years back, it was fine doing business with Syria. Now, suddenly the sanctions come in one day and people are in the middle of activity. They've got personnel there. They need to, get money to them to support their activities. Yes, we are seeing a lot of challenges because, frankly, the world is connected these days. The governments have the ability to trace the money a little bit more cleanly, but at the same time, there are certain concerns over money laundering and terrorist groups that you want to make sure, who is actually receiving the money. So it goes back to the know your customers, sort of the global term. It really means know the folks with whom you're dealing, whether it's the bank. You want to get in-country due diligence. You want to understand who are you actually dealing with, and look for guidance from folks, lawyers and the like in that particular country. We work regularly with local counsel around the globe to help that because it's a tricky world.
And Lindsay, someone else is asking, is there an relatively easy to use procedure or website or other to kind of look up individuals, companies, entities that are on the OFAC sanctions list or otherwise prohibited from doing business with?
Yeah, great question. So the sanctions list is actually just one of about 8 lists that the various government agencies have. Fortunately, several years ago, the government, the big G, consolidated. So there is a consolidated list that you can review. I don't have it in this slide work, but we can certainly put it as part of the follow-up package. That might be the easiest way to do that. So you do want to screen. There's an entity list. There are all sorts of lists, but the government has now consolidated down to a consolidated list accessible on the website. It changes daily because the various agencies are adding and subtracting folks. So it is smart, again, for your first line of defense to start there.
Yeah, we'll include that in the materials that go out tomorrow.
Yes, question.
On that site, when you type in someone's name, there's a slider for the percentage match to the name.
Right.
Do you recommend anything other than 100? So 100, my understanding, is exactly spelled as you have it. You slide it back, and it could give you variance.
Yeah, they use the. As far as I understand, the software program uses fuzzy analytics, so it does come up with some false positives. So, I think you have to use your judgment, and if you have additional data beyond just the name that you can corroborate that it is in fact the same individual, again, it's a level of risk. How much risk are you willing to take? Can you find other sources that can either support your decision or raise the risk level even more, where you want to back away because it's not worth it? Yes. So the question was, if you get a response back that says no results, what do you recommend? Do a PDF and save that? Yes, I certainly would keep a copy of that because you want to have your basis for moving forward, and that does make sense. But make sure it's spelled right, and make sure you're careful with put in as much information or have as much information as possible, so that you can again either try and corroborate whether it's a match or not. Okay, so other, obviously, foreign law considerations and restrictions you want to consider. So are there foreign controls on currency flow coming from that particular country? Many countries will require a license before you can transmit money. Others have prohibitions on remittances of hard currency. That was true certainly in China for many, many years. You could bring the money in, but you couldn't get it out and had to be, locally reinvested. So you have to be mindful not only of the restrictions from the U.S. perspective, but also from your local country restrictions as well. So are there any practical challenges in either collecting revenue or dues or repatriating the funds that you have acquired from your activities there? Again, it's often more challenging even than the U.S. restrictions. Additionally, you want to give some consideration to foreign investment. So when you're thinking about what we talked about before, the sliding scale of activity and involvement, think about that. It's easy to jump in, and oftentimes it's hard to extract yourself, which is why many people take kind of a measured and stepwise approach.
On that point, So, as Lindsay said, it's easy to get in a country, but then it's hard to get out. So what we often see that non-for-profits go into a country and they may set up a branch or they might set up an organization, and then they realize for whatever reasons things are changing and then they want to get out. And so in many jurisdictions, for example, China, in order to liquidate an entity, it's going to take up to 2 or 3 years. The best case scenario is in the UK, you can do this over maybe 90 days. If you're in Brazil, you're looking at a multi-year process before you can kind of like really leave the jurisdiction. So it's easy to get in, but be mindful that once you're in, you're pretty much in for a while.
And to that end, depending on the nature of your activity, sometimes it may make sense to stagger the series of payments that you make rather than paying everything up front. If it is going to be difficult to get money out of a jurisdiction, depending on what it is that you're doing, you may want to schedule those payments to retain some flexibility.
And then just other issues to think about. Is your activity in that country within, for example, a national public policy priority such that it'll be supported, or are you going to be running into headwind? Is it, does it run contrary to the activity? Because that's sort of a substantive but challenging issue oftentimes to delineate. So you want to make sure that your activity will be supported. There are enough restrictions out there anyway just to undertake your activity, but you want to think about, have there been certain actions by the local governments that would run afoul or be extra challenging to what you're trying to achieve there. We have seen, for example, in India, there's been a lot of crackdown and scrutiny by the government on not-for-profit organizations there, just by way of example. And then there are other countries where they want to support, if it's a green initiative, for example, they're more willing to provide flexibility and support your activities. So just something to think about. Okay, compliance considerations. We're just going to zip through these. I think you want to be mindful of your arrangements with folks, and certainly putting things in writing is advisable. And I've listed, 5 or 6, 7, 8 on the bottom there where we tend to see the most sticky issues and provisions. So everything from dispute resolution to ensuring compliance and getting the partner on the other side agreeing and acknowledging as to compliance issues, anti-corruption, sanctions, et cetera. Remembering governing lawsuit to the extent that you can. Include the excluding conflicts of law provisions. In some jurisdictions, you're required to apply local law, but certainly if you can get home cooking, you want home cooking. Remember agency versus independent contractor. Again, agency being an extension of your activity, independent contractor, you've attempted to have an arm's length activity and separation. So those are some of the things that we have seen, and in addition to following the money to support your activities, you just want to be mindful of those.
And one additional point on that, so there are various jurisdictions where you actually have to write these agreements in local language. So you can't actually do it in English. So, for example, in Russia, many of those agreements have to be basically in English and then in Russian and Russian controls.
Right, that's true. And so make sure that the translation is bang on, as we say. And then I guess I didn't touch upon the bullet point at the top. So we always look at it in two ways. You have regulatory or legal restrictions, and then you have contractual restrictions as well. And so with any issue that comes up, you want to be mindful of that. You may have restrictions from the regulatory side of it, in other words, the government imposed, whether it's local government, U.S. government, and then you have contractual restrictions where you may be in compliance from a regulatory standpoint, but you may run afoul of your contractual obligations. And then just a couple of the examples that we have seen. We've seen requests to either over-invoice. Okay, well, we're sending you these materials, and we'd like you to invoice double for what you normally charge. Or we'd like a second set of invoices, one with the, quote-unquote, real amount and one with the other. And, obviously that's issues in red flag. The flag should be clearly up at the top of the pole for when requests like that come in. And they just say, well, it helps us with the local processing. It's easier here. just say no, in the words of Nancy Reagan, because really what they're effectively trying to do is either evade local tax obligations, avoid restrictions on currency restrictions, and you can be brought in under an aiding and abetting violation as well. We also have seen requests to pay outside of the foreign country of the particular organization where they say, yeah, thanks very much, but if you wouldn't mind, just deposit that into our account in Caymans. That would be much more convenient for us. Again, just say no. Potential risks, see above. And then finally, avoid the cash mule, which is one of the ones that I talked about before. Make sure that your team feels empowered to come back to you and say, this is what's being requested of me. What should I do? Rather than just come up with some program themselves where they think it's a good fix. So with that, I am going to turn it over to Friedemann.
So after Lindsay's exploration on what you have to consider when you want to move or do business overseas or be activities overseas, do you guys really want to talk about tax issue? Because it's going to get even worse. So, but I will try to keep that relatively light as much as I can. Okay. So, going back to the general theme about funds flowing outside the U.S. or inside the U.S. or cross-border payments, certain payments of money will be subject to tax withholding in the United States. And so it's very important to consider, if you make a payment of $100, whether or not the IRS wants to get its piece for that. Another general rule, which is really important, is that every payment that a non-for-profit makes outside of the U.S. is subject to an IRS documentation requirement. It sometimes requires to obtain certain forms from the recipient. It sometimes requires filings with your annual returns, but you have to be aware of it. And the way how we get involved, or I get involved a lot, is you have a non-for-profit, for example, having directors who are not from the U.S., but they're in Canada or they're in the U.K., and they come to the U.S., they have a board meeting, and then there is a payment paid either for compensation or for reimbursement. And these payments may be made, but nobody thinks about the reporting obligations, and that's going to come back once actually you have to file your tax returns. So my recommendation is always, literally, if you make a payment outside of the U.S., think tax, because there will be a paper or something to be collected. So types of payments, what are we actually talking about? So there are the typical types of payment on interest, dividends, rents, royalties, and the licensing, etc. Those are called in tax language portfolio income, and they are all subject to a withholding tax, unless you get an exemption. We'll get to that later. Other payments is payment that is kind of like connected to some U.S. activities. And that type of income is often subject to a withholding because the recipient should actually be paying U.S. tax on that receipt. So again, let's go back to the board meeting that was held in D.C., which with a Canadian resident. Well, that income, if he gets compensated for those services, is actually subject to U.S. tax. Well, the IRS says primarily the liability will be with the person who is making the payment to a non-U.S. person or a person that is generally not subject to U.S. tax. And therefore, the non-for-profit should either collect a form from that board member or withhold the appropriate amount. Another area where you have a withholding tax payment is when you have a real estate transaction. When a non-for-profit sells a real estate, there could be a withholding tax imposed as well. And then, as I mentioned, the compensation for personal and professional services and gifts and grants is a reporting obligation.
And actually, before you move on, and I should have said this, and we do also have a question in the back. in addition to everything, all of the considerations that Lindsay talked about, and that Friedemann is starting to and is about to talk about. For those of you, and I know there are many of you in the room and on the webinar today that are federal grant and cooperative agreement and contract recipients, or parties to federal grants, contracts, and cooperative agreements, there are a whole nother level of requirements, as you all well know, that come into play there too. We're not talking about those today. We do many programs focused on those issues, as many of you know. But many of you are dealing with all of those compliance considerations as well, including regarding the movement of money and paying subgrantees and subrecipients and subcontractors overseas and whatnot. And so keep all of those considerations in mind as well. It is complicated and difficult and confusing to deal with all of this, but you really, if you can kind of think of it in those three buckets, the Friedemann bucket, the Lindsay bucket, and kind of the federal grant and contract bucket, you really have to take all of those considerations into account whenever you're moving money overseas or back.
Okay. Thanks, Jeff. There was another
Sorry, question in the back.
Yeah, just a question. We have a couple clients, and they have people who they pay stipends to for travel to conferences, either in the U.S. or in another country. Are those also subject to withholding tax, or not payment for services, but they are akin to scholarship payments?
Very, very good question. So the stipend itself it's not so relevant. The relevancy is who is receiving the stipend. If the stipend is paid for a person who is outside of the U.S., then there are reporting obligations. If the person is made if the payment is made to a person that is inside the U.S., you still should get a W-9 to verify that person is actually a U.S. person, but you don't have to kind of like have a withholding obligation. Moving on to kind of like what are the kind of like the withholding tax obligations on cross-border payments. I listed the kind of like a few countries here, and the relevancy of this is if you make a payment that is a portfolio, meaning interest, royalty, dividends, there's always a 30% withholding tax rate applicable in the U.S. unless you can find a tax treaty with the U.S., and under those tax treaties, that withholding tax might be reduced. And so I'm listing, again, the U.S. has over 80 tax treaties with various jurisdictions, but kind of like just to give you a flavor on what I'm talking about, you basically can take China. If you make a payment into China and the Chinese recipient would qualify for treaty benefits, then you have it's a reduced withholding tax rate down to 10%. Similar, if they have a treaty, the U.S. have a treaty with Germany, and then the German-U.S. tax treaty, you can get a reduction in the withholding tax rate. This is all premised on the notion that you actually have to comply or collect the proper forms. This is another issue for folks who don't pay attention. Just because the person is located in a jurisdiction where they could get treaty benefits, that doesn't mean that they necessarily qualify for those treaty benefits. So we have been advising a non-for-profit organization that has a number of folks who are providing services in Canada. And Canada and the U.S., they have a tax treaty in place. And we basically said to the recipient, you need to comply with these withholding tax rules, and we need to get some of the forms that you identify yourself as a Canadian citizen or Canadian tax resident, and you need to show us that you actually qualify for treaty benefits. And the person sends us an email and said, yes. And we reply and say, well, that's fine, except you need to actually complete these forms and sign under the penalty of perjury that you actually qualify. And so it turns out in this specific instance, this person was living in Canada, but actually their tax residency was in the Cayman Islands. So that one is and so once we became aware, even if you would get the form under the penalty of perjury signed, if you have facts that are contradictory to what you received in the forms, you still have an obligation to withhold.
So that's sort of like the rule, I'm from Missouri, the show me state, so see the documents.
Yes, and it's maybe even more complicated because we run into this all the time where we basically have a certification by the recipient and we have to continue digging to get more facts to actually getting comfortable that there's no withholding tax obligation. These are kind of like the limitations I'm listing here that you need to qualify for treaty benefits. And there's a limitation of benefits clause for folks who are doing treaty shopping. So that's a very used to be very common, a little bit less common because of the OECD has kind of like put in new rules in place. But basically what treaty shopping is because the U.S. has tax treaties with lots of jurisdictions, some of those treaties are more favorable, some of those are less favorable, then recipients have often kind of like said, well, let me look around wherever I can find the best tax treaty, and that's the one I'm going to use. So that obviously doesn't matter. The last point is relevant for really the recipients, again, kind of like tax credit considerations. So when folks are getting remunerations from non-for-profits for board services, personal services, etc., they're still subject to tax in their local country. And so even if there's a withholding tax, that might be okay because that will usually generate a foreign tax credit for those folks. And so that means they can utilize those tax credits against their own tax liability in the country.
Friedemann, we have a couple questions from folks, and maybe it's a good lead into this slide, asking, where can they go, on the IRS website or otherwise to try to find out, is there a list of all these various requirements, withholding requirements, forms to use? Obviously, anyone is always welcome to call you and hire Venable to assist. But if someone wanted to do it on their own, and the IRS, as we all, well, at least as Yossi and I and you well know, its website is not always the most user-friendly in some areas, but in other areas it actually can be. Tell us about here.
No, this is an excellent question, and I wish I would have the perfect answer, except call me. So the IRS website, despite its reputation, is actually pretty good. It's not the most user-friendly website, but once you kind of go through the first level, you will find actually very useful information. So, for example, all of the tax treaties that the U.S. entered into are listed on the IRS website. All of the forms that I'm listing here, and I will spare you that I'm going to go through all of those forms, but all of those forms are actually relevant with respect to cross-border payments. They're all on the IRS website. The person who the question about can you do it yourself, let me put it this way. The instructions to these various forms, the IRS has made an effort to draft them in plain English. So that would be my recommendation, to start there with those kind of like explanations to the forms. And they usually give you a very good scope and explanation why that form might be necessary. Moreover, it often explains to you that you're at the wrong form, but actually points you to the right form. So that's kind of like the way I would approach it. I have several non-for-profit clients. What they do, they kind of like prepare the forms, and then they send them to us just to review it so that they make sure they actually get it right. So, couple high points on that slide. So everything that is a W-8, those are forms that are basically having two main purposes. One purpose is it's the identification of that person being a non-U.S. person. A W-9, which I didn't list here, is that you are a U.S. person. And you need to obtain that, period. So whenever you make a payment to a non-U.S. person, I highly recommend you to obtain that form. The other reason why that form is often utilized is in order to claim treaty benefits. So it's a dual purpose. So many times people tell me, I'm not claiming treaty benefits, therefore I don't need to give you that form. But the form really gives you certainty that the payment you're making is to a person that is not a U.S. person. The other forms, and I'm just going to pick one of those. It's the 1042. This goes back to my previous story about the board meeting held in the U.S. and one of the board members being a Canadian citizen. You have to file a 1042 with your tax return when you make those payments, or you have to withhold payments. Okay. There's a question.
Wait, just wait for the mic.
If you're doing a transfer to an organization, you're collecting donations here and you're transferring, and that donation is for an entity in another country, European country. Is the organization to which you're transferring the money considered a person?
Thank you for the question, and that is actually fantastic. Yes. So when and I probably should have clarified that before, whenever tax lawyers speak, person includes individuals, organizations, corporations, branches, partnerships, you name it. So the application is not just to individuals. It's basically any payment you make to a organization outside of the U.S. in whatever form it is. Okay, switching gears slightly, bank accounts. So obviously, folks like to set up bank accounts outside of the U.S. Lindsay also already kind of like spoke about the anti-money laundering regulation, so I'm not going to repeat that. She also mentioned the KYC, but the one thing I do want to emphasize on the KYC requirements and know your customer requirements. Those requirements have become incredibly onerous over the last few years. And so I can tell you lots of horror stories about us helping non-for-profits organizations to set up their branches or to set up their organizations outside of the U.S., and they wanted to open a bank account in that local jurisdiction. The verification process is often much, much more onerous than in the U.S. So in the U.S., you can get something certified relatively easy. In many jurisdictions, it's a process called apostille, and that implies that you have to go to an embassy. You have to show a proof of residency, including utility bills, including proof of residency that you actually live in that apartment or that you own it. So the process of actually going through the KYC requirement is more and more onerous, and what's important when you start kind of like thinking about opening a bank account, it takes time. So my experience, it often takes 2 to 3 to 4 months time till you have a bank account opened in a non-US jurisdiction. So one other item, and I want to be cognizant of time, so I'm not monopolizing everything here. CRS, so Common Reporting Standards. This is actually a relatively new initiative, again, developed by the OECD. And it really goes to a transparency initiative that is akin to what we have here in the US on FACTA, where you really want to kind of like have a trace of the money. And the reason why I mention this is because the CRS standards are now being rolled out. I mean, they're really effective as of January 1, 2017 in many of those jurisdictions, including the EU. And even China has signed up for that, and that's beginning of 2018. And what that means really is that banks, whenever they are accepting a deposit of cash, they have an obligation to have an automatic exchange of information with whoever owns that bank account. And in order to comply with that, the banks themselves are required to have an understanding of where the source of funds comes from. So they are really, really tracing that cash, which again is an additional obligation or kind of like burden on non-for-profit.
What does OECD stand for, if you want to explain to everyone?
So, hold on.
The middle button.
Yeah. The Organization of Economic Cooperation Development. So basically,
wasn't intended to be a test.
It was a test, but
we all use the acronyms and not the full names.
We all use the acronyms, but the point about the OECD is it's really a global organization that is really trying to create a level playing field on tax compliance. That's really one of their primary focuses. We probably could have a very lengthy discussion about the sense of sensibility of this initiative, but I will leave that up to a different time. Okay. I have 2 more slides, and I want to kind of like use those more as a case study. So one thing that I run into all the time is the following fact patterns. You have a U.S. non-for-profit organization who says, we are hiring an in-country manager who is being sent to Brazil, but they like to keep their U.S. benefits, insurance, health insurance usually, 401k. These are kind of like mainly the driver that they like to keep. Well, if you send a person to Brazil and let that person be employed by your local organization in Brazil, they will lose their 401k, meaning they are not qualifying for a 401k, and they also will not have accessibility to their U.S. insurance. If you send the employee to Brazil and you let them employed by your non-for-profit U.S. company, you are creating a so-called taxable presence in Brazil. And with that comes a lots of compliance burdens and potentially tax exposure of your non-for-profit in the U.S. in Brazil. So a way to accommodate both of these, kind of like to solve that tension between the compliance and tax exposure that your non-for-profit would have in Brazil and to satisfy the person who would like to keep their benefits in the U.S., we often kind of like put in place so-called secondment arrangements. And so what a secondment arrangement basically is, you are letting the employee be on your payroll as an employee in the U.S., but you're actually farming them out, so to speak, to your Brazilian whatever organization you have there. And so, and then there is an arrangement between your U.S. company or your U.S. non-for-profit and your Brazilian entity, whereas basically the U.S. non-for-profit says, I'm going to pay the salary to you, but you employ them. And so what you do by doing that, what you really accomplish, you kind of like basically isolate the legal and the tax liability, and you keep the secondee or the person who is spending time in Brazil on your 401k as well as on the health insurance in the U.S. So that's one technique we employ. Another technique, and it goes back to what Lindsay mentioned at the very beginning of the presentation, and it was what I mentioned a couple times as well. There's a real compliance cost with doing business outside of the U.S. or having activities outside of the U.S. And just kind of like as a range, our experience is having, an organization outside of the U.S. doing all of the compliance work, whether it's filing tax returns, whether it's complying with local law. In our experience, the low-cost countries, which are really kind of like Canada, the UK, Commonwealth countries, usually runs anywhere between 5 and 10K annually. So there's a real cost in running those, kind of like a company outside of the US. On the high end, if you look at countries like Brazil or Russia or India or China, those costs could be a multiple of what I mentioned before. So non-for-profits often have the question to me, say, Friedman, we don't want to incur those costs given that we don't have and yet know whether we're going to stay there. So one of the solutions that we have come up with is the following. So if you employ these folks in the U.S. and you send them outside of the U.S., and in some jurisdictions like China, you can't do it, but for example, in Europe, you can do that. What you do by doing that, you basically expose your non-for-profit company in the U.S. to all of the regulatory and tax obligations in these countries. And that could mean that whatever you have in the U.S. could be suddenly subject to tax in the U.K., which could have devastating impacts. In order to mitigate that, what a non-for-profit can do, you can set up basically an employment company, and it's a very simple thing. You basically set up an LLC underneath your non-for-profit, and that entity is literally, it's just a shell company, and that entity will become the employer of record for the folks you're sending outside of the U.S. Why is that powerful? It's powerful because if there is a claim by a taxing authority from the UK, the Inland Revenue, or you name it, they will look at that first tier or the employment LLC to have a claim against it. But the employment LLC doesn't really have anything other than the employees and has nothing to claim against. And so you basically isolate, or you isolate your risk to one entity, and you don't suddenly have a problem that the HMRC could look after all of your parent company.
Friedman, would this be a single-member disregarded LLC for federal tax purposes?
So, Jeff, good question. Yes. So it would be a wholly owned single-member LLC. So from a tax perspective, you haven't actually changed anything, but from a legal perspective, you have isolated your liability to that entity.
And we use single-member LLCs quite a bit in the nonprofit world for various reasons, including here, most notably for liability protection. But for tax purposes, it's as if it doesn't exist. So the federal tax-exempt status, for instance, of your nonprofit will extend to that LLC. There will not be any separate federal tax reporting required for the LLC. It all gets rolled up into your parent nonprofit.
Yeah, and so in that sense, it kind of like from a U.S. perspective, you haven't actually changed anything, but from a non-U.S. perspective, you have changed anything and you have isolated the risk. So that's a nifty way to kind of like mitigate that risk.
From an employment tax standpoint, is it treated as a separate entity?
So from an employment tax, you have to get a separate EIN. But you can roll it back into your company. So all what you need to do is really get an EIN. Okay, so my last slide. Some other considerations, and I will be very brief. These are kind of like whenever you do business with organizations outside of the U.S., you have to have documentations in place, and that's really important. So if you set up an organization in Brazil and you wholly own it, you need to have intercompany arrangements so that you can justify your payments back and forth. Always keep in mind kind of like the legal and the regulatory restrictions. So for example, out of Brazil or out of China, you have foreign currency issues, and so you often have to either apply to the Central Bank of Brazil to make it money transfer outside of into or outside of Brazil. In China, you have just the RMB foreign currency exchange control issues. So kind of like just keep those in mind. And then lastly, people always ask me, well, is cash movement equal to legal movement? And the short answer is, in Europe, cash movement has actually very little to do with legal movement. But then in South America, many times the legal movement and the cash movement actually have to go hand in hand. So that's another kind of like a planning restriction or planning thing you have to keep in mind in when you conduct your operations outside of the U.S.
You have a question there.
Yes. Is Brazil and China the only two countries where there's a limit on sending cash?
I think there are several African jurisdictions that have also foreign currency control issues, and I know that Russia also has some foreign currency control issues.
All right, now it's time for our final speaker, Yossi Ziffer, to talk about international grant making by nonprofits.
Can I do a follow-up? How would I find out what the African countries are?
Yeah, I need to get back to you on that one.
Yeah, just follow up with Friedemann separately. Contact information will be on the last slide. All right, Yossi?
Okay. So at this point, if you've considered and addressed all of the important issues that Lindsay mentioned and Friedemann mentioned, you might have thought that you were home free. But wait, there's more. Because on top of all the international issues and the tax compliance matters, it's important to also not lose sight of the fact that fundamentally we're dealing with nonprofit organizations. And so there's a mission-related aspect to how you should look at all of your international activities. Specifically, as a nonprofit, your organization enjoys a privileged status as a tax-exempt entity. But that's based on ensuring that your activities are undertaken in furtherance of those exempt purposes. So what we're going to focus on in the last part of today's program is procedures and steps that nonprofits can take in order to ensure that their international activities, particularly grant making, is undertaken in a manner that's consistent with the overall programmatic guidelines that apply to your organization.
And we should say that these rules apply to all forms of tax-exempt organizations, not just 501c3 organizations. I know there's a number of 501c6 organizations also represented in the registration list here today, and all organizations that are tax-exempt have a responsibility to ensure that the funds that they are spending, that they're sending overseas or otherwise using, are in furtherance of their exempt status.
Now, what's interesting about this is that for most organizations, there actually is not a specific set of rules that you need to look at or comply with in doing this. Rather, it's a more general approach of exercising oversight with respect to your international grants, and the IRS will expect that your organization will ensure that your grant making is consistent with your tax-exempt purposes. Now, with that being said, for some charitable organizations, so that's organizations described in Section 501c3, and specifically those that are classified as private foundations, there is a set of rules that are mandatory, and those apply to international grant making. And although they don't apply to other types of nonprofits, they can provide us with a useful framework about how to think about these issues. And for that reason, the main part of our discussion now is going to focus on these steps, and you can think about, if you're not actually a private foundation, how these rules might apply either in their actual or in a modified form to fit your organization. And these rules are known as expenditure responsibility, and they amount to a due diligence process that the grantor organization, the organization that's paying the money, exercises with respect to the grant that it's awarding. And what the rules basically say is that even though the identity of the grantee that's receiving the grant does not by itself assure us that the money will be used, the funds will be used in furtherance of your organization's purposes, but if you go through this process of exercising due diligence with respect to the grant, you can assure yourself with a relative degree of certainty that you've taken appropriate safeguards to make sure that the funds themselves are used for those purposes and therefore don't run contrary to your organization's purposes. Now, it's also worth noting that for private foundations, there is an alternative way of approaching this issue. That's rather than exercising due diligence with respect to the grant, you can actually undertake a process of evaluating the status of your international grantee. And that process is known as performing an equivalency determination, which, as the name suggests, means that your organization essentially steps into the shoes of the IRS and evaluates the organization and operation of the grantee and concludes that it is the equivalent of a U.S. charity. Now, we're not going to focus on that process today, but I did want to mention that the other place where you see equivalency determinations arise is in one of the issues that Friedman mentioned before when it comes to withholding, that one way to address a withholding requirement is to undertake a similar type of equivalency determination to determine that the grantee is the equivalent of a U.S. public charity.
We should add that process is generally not simple or quick or inexpensive,
Sure.
and as a result, it's not something that organizations typically want to undertake.
Right. So as the slide mentions, expenditure responsibility, again, is only required for those 501c3 entities that are classified as private foundations. It also applies to donor-advised funds, which actually aren't their own separate legal entities. They're funds within a larger public charity. So when we talk about expenditure responsibility, there are three main elements. First, a limited pre-grant inquiry regarding the proposed grantee. Second, a written grant agreement. And third, a reporting mechanism to monitor the way in which the grant funds are actually used and the progress that's being made toward the stated purpose of the grant. We'll take a couple minutes now just to further discuss and unpack each of these components. So, notwithstanding what I said before, although you don't have to undertake a full evaluation of the grantee to determine that it's the equivalent of a U.S. charity, expenditure responsibility does provide that the first step in awarding an international grant is to become familiar with the grantee, to give your organization the assurance that the grantee is well positioned and able to use the grant for the purposes for which it's being awarded. And so the analysis does not have to conclude that this organization, if it was formed here in the U.S., would actually be a charity, but you have to assure yourself that there are enough safeguards in place that the grant funds will be used appropriately. And for that reason, the specific manner in which you go about undertaking that process really depends on all of the facts and circumstances involved. So one thing is, what is the purpose that the grant is being given for? Is it a relatively targeted grant? Is it something with a larger purpose? How much money is involved? Also, what's your prior experience with this organization? If you've had a history of awarding grants to the same organization overseas, and they have a track record of delivering and using the grant funds in the way that was envisioned, so you don't have to compartmentalize that knowledge and pretend you've never met these people before. You can certainly use all of the available information to go through the pre-grant inquiry. And so if you have a high degree of familiarity with your grantee organization, then the specific requirements in this step can certainly be reduced or really practically eliminated. Once you've gone through that process and you feel comfortable that this organization is an appropriate recipient of your grant, you then come to actually memorializing the terms of the grant in a written grant agreement. And in many ways, this is the central component of expenditure responsibility. So what do you want to have in your grant agreement? Well, first and foremost, you have to state the purpose of the grants, and you want to make sure that this is really spelled out very clearly. And in that respect, it's worth noting that expenditure responsibility in particular, but really international grant making overall, favors grants for specific programs or activities rather than a general support grant to the organization. Because if you haven't determined that this organization is the equivalent of a U.S. charity and is subject to all of the restrictions, or a U.S. nonprofit really, if you haven't determined that the organization is subject to all of the same restrictions that apply to your organization, then by just giving them a general support grant and saying, hey, go use this for your purposes, you won't be sufficiently assured that the use of those funds is limited to all of the restrictions that apply to your organization here. And so in spelling out the purposes of the grant, you really want to make sure that the grantee understands what it can and cannot do with these funds, and the contours of those limitations should be drawn in a manner that complies with your nonprofit's tax-exempt status.
And Yessie, I'm sure you would agree that it's really important not to just say, you shall use this grant for any purpose consistent with 501c3 status, but that you make it very specific to your own organization's tax-exempt purposes and the specific purposes that are the basis for your organization's exemption. And the more specific you can be in that regard, the safer you're going to be.
Absolutely. I mean, sometimes in grant agreements, we'll see that folks have written something like, and you can't use the grant funds for any purpose that was not permitted under Section 4945 D3 and 4 of the Internal Revenue Code. Well, your grantee overseas really is probably not going to know what that means, and so it's worth spelling it out in terms that are understandable and accessible to all parties. Absolutely. So, furthermore, in addition to spelling out affirmatively what the grant funds should be used for, the grant agreement should also include specific safeguards and consequences for what happens if the grant funds are used in a manner other than what you've specified. And to that end, the grant agreement should specifically bind and commit the grantee to repay any amounts to your organization that have been used for a non-permissible purpose, and also to spell out any specific purposes that that grant funds could not be used for with respect to your own tax-exempt status. So again, to just take an example from the charitable area, charities are generally limited to the extent that they can engage in lobbying activities and pretty much completely precluded from engaging in political activities in connection with elections. And so if your organization is a 501c3, is a charity, you would want to spell out in your grant agreement that the grant funds can't be used for any of those purposes. If your nonprofit is a 501c4 or a 501c6, those restrictions are not necessarily applicable, and so you wouldn't have to include them, although, again, there may be other programmatic reasons why you would want to narrowly tailor what the grant funds can be used for. So you don't have to necessarily permit use for anything that would be consistent with your particular tax-exempt status. You can still narrow it programmatically however you see fit. The grant agreement should also spell out specific reporting obligations expected of the grantee, and that ties into the third element of expenditure responsibility, and we'll get to those in just a moment. And finally, the grant agreement should also require the grantee organization to maintain adequate books and records, again, in the spirit of overall due diligence that your organization is going to exercise with respect to this grant. You want to make sure that the grantee is maintaining appropriate records and that you have reasonable access to those records just so that you can exercise appropriate oversight. Now, there's also a concept within the technical expenditure responsibility rules that apply to private foundations in some instances that the grant funds have to be held in a segregated fund or account. And that doesn't always apply, and the rules permit an organizational manager from the grantor to determine that the organization receiving the funds is, again, more or less the same as a nonprofit here in the U.S. So if a private foundation was awarding a grant and determined that the organization, the grantee, was the equivalent of a charity, the foundation would not need to specifically require that the grant be held in a separate fund or account. However, it's out there, and it's something that you can keep in your back pocket, again, depending on the particular nature of the grant and the grantee and your degree of comfort with respect to how the grant funds are used. That's something that you could consider including in a grant agreement if your organization felt that additional assurances are appropriate.
We even had a situation in the last week or so where a client of ours, the grantee, it turned out, unbeknownst to our client, had taken some of the grant funds and encumbered them as part of loans that they had taken out, and it was collateral for loans. And now we're trying to separate and trying to get the money back, and all of a sudden the money's not free and clear. And it's a real problem. So it's also worth considering other kind of prohibitions or other considerations to factor into your grant agreement if you want to make sure that something like that doesn't happen.
Now, admittedly, we've been focusing on grants because that's sort of the typical way in which U.S. nonprofit can send money overseas to help an organization there. Just want to take a moment to note that there are other forms, other grant-like transactions that also come within these rules. And you may be familiar with the concept of a program-related investment, or a PRI. PRIs are also technically, by their terms, something from the private foundation context, although they've certainly become more of a term of art, and organizations that are not private foundations speak about making PRIs. PRIs are essentially equity investments or loans made to organizations where there's still an overriding nonprofit, charitable, or otherwise purpose that's being accomplished through the investment. And the expenditure responsibility rules and the grant agreement aspects of that in particular apply some separate provisions in the case of a grant agreement governing a PRI. Just in the interest of time, we won't go through those specifically, but again, they're sort of the same flavor as the grant provisions, but made to fit an equity investment or a loan context as well. Finally, the third aspect of expenditure responsibility is to require grantee reporting, where the grantee regularly accounts for the use of the funds, demonstrates compliance with the grant terms, and illustrates progress toward achieving the grant objective. Under the expenditure responsibility rules, those reports are required annually for any year in which the grantee either receives or uses grant funds. So in some instances, that may just reduce itself to a single report if it's a one-time grant and the money gets used within that year. In other instances, if you're talking about a multi-year grant or a longer-term project, you may be setting yourself up for several years of reporting. And the rules also contemplate a final report that's issued by the grantee when the grant funds are finally used up. In the context of private foundations that are required to comply with these rules, there is a flip side to the grantee reports where the foundation grantor has to in turn turn around and make reports to the IRS through its Form 990-PF on any outstanding expenditure responsibility grants that it has awarded. Again, because we're sort of using this model as an analogy for nonprofits that are not limited to private foundations, if your organization is not a private foundation, your tax reporting won't specifically include an area to report on expenditure responsibility grants in this manner. However, it's worth noting that in general, if a nonprofit is undertaking a new substantial area of activity that's different than what it has previously disclosed to the IRS, you would want to highlight that and simply put the IRS on notice that you've undertaken this new type of activity, and you do that through your annual 990. Now, just sort of circling back to the grant agreement aspect of expenditure responsibility, you can tell that we didn't specifically compare our slides here because a lot of these items that I have should look familiar to you from Lindsay's presentation earlier. But just because the expenditure responsibility rules say you have to have A, B, C, and D in your grant agreement, you certainly are not limited to those aspects. And really, you want to make sure that your organization is comfortable, feels confident that your grant is going to be used appropriately. And see that I've listed here just a few things to keep in mind, including the last bullet point, anything you feel is important or helpful. And that's not said in jest. It's actually quite serious, and I'll present that in sort of two contexts. One, just at a very practical level, as the grantor, your organization has the leverage, right? You control the purse strings. And so you should feel confident and really, from a sense of fiduciary duty to insist on the provisions that your management and your board feel are necessary in order to ensure that your grant is being used appropriately. That's just from a negotiation and bargaining perspective. In addition to that, after 9/11, the Treasury Department came out with this document of voluntary best practices for charities that were awarding grants overseas. And Obviously there's a significant concern at that time about terrorist financing, money laundering, but one of the real drawbacks to these guidelines that Treasury put out was that they took a one-size-fits-all approach, and it created a lot of angst and discomfort within the nonprofit community because it didn't seem to take into account all of the things that nonprofits do every day to make sure that their funds are being used appropriately and that the organizations are remaining faithful to their mission. Those guidelines have gone through a couple of sets of revisions. The most recent one came out in 2010. And if you read those, again, they're voluntary. So you're not talking about law here. But on the other hand, it was issued by the Treasury Department. And so people take note of it and they take it seriously. But that document really goes to great lengths to talk about taking a risk-based approach to your international grant making. And they say in these terms, there is no one-size-fits-all approach. So think about what is it that you're doing, where is it that you're doing it. Think back to that heat map that we saw earlier. If you're operating in a part of the world where there is a much higher risk of diversion of funds or misuse of funds, and you want to build in those extra safeguards, but within the realm of all these different tools that we've discussed, think about what's the appropriate way to calibrate your international grant making activity so that you feel comfortable the grant's going to be used appropriately and your organization can continue to make a meaningful difference to the populations that it serves.
Thank you, Jesse. And of course, with regard to that final bullet point, there's a lot of things that you can and perhaps want to put into your grant agreement. A lot of our clients have a good kind of standard model template grant agreement that they start with. Of course, has to be tailored to every situation. And things like the right to perform audits, like a lot of large grant-making organizations retain the right and actually do send out auditors to audit compliance with the various requirements and looking at how the monies are spent. And these are all things that can be very important. But it's for an organization that's in the business of regularly making grants overseas, you really want to want to have a comprehensive form grant agreement that works well for your organization. I want to thank our speakers for a terrific job today. Jesse, Friedemann, and Lindsay, thank you so much. I appreciate everyone coming here today. Hope to see you back here next month. Thank you.